Hi everyone. So I wanted to put together a quick video explaining what the current account is and also how to answer questions on the topic. It's quite regularly examined, so it's important to know. The current account, as I'm sure you know, is within the balance of payments, and the balance of payments is made up of three parts: the current account, financial account, and the capital account. The topic that they tend to examine by far amongst those three is the current account. So let's delve into that. The current account is made up of four parts. So let's go through them one at a time. Number one, the first part is trade in goods. Okay, what does that mean? Well, a good is something that is tangible, so something that I can physically touch, like, for example, a car, an orange. So this is the export and import of tangible products. If I think in terms of the UK, what we tend to be pretty good at in terms of exporting is cars and also pharmaceutical equipment or medicine. That's the two kind of strong areas for the UK economy. Everything else we tend to import a lot of. Yeah, so that's number one. Number two is trade in services. Okay, so what's a service? A service is obviously intangible. So, for example, financial services or legal services, tutoring services. So, I've taught students across the world. Whenever I taught students in Switzerland, Dubai, wherever, that would have counted as an export for the UK. You're all welcome. I'm joking. That's number two. Number three. Number three. Now, sometimes you're taught this as primary income, and I don't mind this, but number three, the way I want you to remember it is called investment income. And I want to make sure that this actually makes sense. So investment income is essentially the rewards that you get for investments that you've made abroad. Right, let's go through two examples to understand this with. The first example is imagine that I own a flat in Milan. Now, I don't live in Milan, I live in London. So what happens? I rent out the flat and the rental income coming from Italy to the UK, that counts as export earnings for the UK economy. And it comes through via investment income. Yeah. So that property that I own, the rent that I get for it, that would count as investment income. Second example is if I buy stocks and shares in companies that are not based in the UK. So let's say, for example, that I buy shares in, I don't know, Apple. Yeah. Now, obviously, Apple is an American company. The purchase of the shares themselves are actually recorded on the financial account. It would count as FDI into America. Me investing into an American company is FDI. But anyways, whenever Apple pay out dividends, so the rewards for basically owning or holding the shares, the money coming into the UK economy from America counts as export earnings for the UK economy. It's investment income. Obviously, vice versa, by the way. When British firms pay out dividends to shareholders that are based abroad, that is an outflow of investment income. That's number three. The last one, number four, is current transfers. And current transfers is basically money going in or out without any corresponding output. Now, there are two examples that they tend to examine or want you to know. Number one is international aid. So if the UK pays out aid to a developing economy, that is money leaving the economy without anything coming back in return. That is counted as part of as an outflow of current transfers. You may have heard of this concept, especially those of you that do geography, called remittances. Remittances is basically people who work abroad and then send money back to their family. That money coming into that economy is an inflow of current transfers. The money leaving wherever that person is based is outflow of current transfer. Yeah, cool. So hopefully that's a nice quick overview of what the current account is. If you were asked to define what the current account is, by the way, the easiest way to define it, or the correct way to define it, is the value of exports minus the value of imports. It is very important that you add the word value, by the way, because if you just write exports minus imports, that is looking at it purely from a quantity perspective. That is not true. It is the quantity multiplied by the actual price that we're getting or paying for exports and imports. Yeah. So, anyways, total value of exports minus total value of imports will get you 1 or 2 mark definition if you get questions on that. Right. Let's delve into questions because I think that that's a lot more exciting and kind of more fruitful. So, I'm going to open on our website. I've actually opened it already. The balance of payments. Here we go. Let's start from the beginning, actually. This is one of the booklets of questions by topic, and it's the balance of payments. And you'll notice that all the questions are about the current account, which is very typical of Edexcel. So let's start and work our way through this. Let me zoom out a little bit so you guys can see this a bit clearer. It shows the British pound to US dollar exchange rate, the value of £1 in dollars, June 2017 to June 2019. Which one of the following has been the overall change in the British pound to the US dollar exchange rate from the 1st of January 2018? So they very handily put a dot for you there, by the way. 1st January is there. To 1st of January 2019. Okay, right. Let's ignore the options. Obviously, I know that you get options in the exam and that will help. Let's just make sure that we actually understand this. If it's not really clear and you can't visualize it, the best thing to do is to write on the paper, yeah, and write the numbers out. So I'm going to do that with you guys. So if I Look at what the axis shows, by the way. It shows the value of £1 in dollars. In other words, £1 equals, right? So how many dollars? Let me find the dollar sign on my laptop. There we go. £1 was equal to $1.35 in 2018. Okay, cool. I then compare it and I go £1 in 2019 is equal to how many dollars? Well, it's equal to $1.25. Okay. My question is simple. If I look at it that way, I think it makes it a lot easier to kind of see this. But has the pound, sorry, got stronger or weaker relative to the dollar? Well, it used to be able to buy $1.35. It can now only buy $1.25. It's clearly got weaker. How do I describe that? Well, I describe that as a depreciation. Now, quickly to distinguish between a depreciation and devaluation. Depreciation is pure supply and demand. There is no government or central bank intervention. The pound is not on a fixed exchange rate, it's a floating exchange rate. So that we describe as a depreciation. If, on the other hand, the central bank had intervened and made the pound weaker, that is not a depreciation, that is a devaluation. So let's look through the options. Let's clear the annotations. If we look now at the options, what do we have? We just need to look for depreciation. Oh, there we go. B. Yeah, obviously the answer is B. It's a depreciation. Yeah, nice, easy question to warm you up. The second question is the following. Right. The second question is explain the likely impact of the change in the exchange rate of the pound shown in the graph from the 1st of January to 1st of January 2018, 2019 on the current account of the balance of payments. Okay, really important discussion. Before I delve into the theory, if in section A you get a 3 or 4 marker, even if it explicitly doesn't state this, even though this time it does, you need to know that at least one mark is reserved for application. So whatever data they've given you or little kind of paragraph of writing they've given, you need to reference it. You need to reference as a means of getting application. Right, let's do some revision. From now on, when it comes to the current account and exports and imports, I forevermore want you to remember 2 countries. There are 2 countries in the global market who are big, big exporters, but the logic of why they are exporters is not quite the same. The first big exporting country that you should know is China. Right, why do people buy Chinese goods? Well, Chinese goods typically are cheaper than other countries. So in other words, if you're cheaper, you are what we call more price competitive. So China are price competitive. That's the first one. The second example is Germany. Germany, think about the cars that they basically produce, so BMW, Audi, Volkswagen, I know they're kind of own each other, Mercedes, etc. These are not cheap cars, they're not cheap products. What are they known for? They are known for their quality. In other words, when you get questions about the current account, I just need you to consistently remember a country is either price competitive or quality competitive or both. Okay, so let's now answer the question. We know from the question above that the pound depreciated. Well, if the pound depreciates, does that make the UK more or less price competitive? Now, some of you may potentially be saying less. Can I clarify why the answer is more? If the pound is weaker, it's cheaper basically, it makes British goods more attractive. Remember earlier I said that people buy Chinese goods because China is price competitive because they're cheaper? Same thing here. So the logic of kind of the chain of reasoning is going to be this, is that the depreciation of the pound from January 2018 to January 2019, reference by the way, go from 1.35 to 1.25, makes the UK economy more internationally price competitive. That's 2 marks, by the way, because we did an application and we said more price competitive. As a result, exports out of the UK are likely to rise. Now, briefly, I'd explain why, even though it's a 4 marker, it's not worth the 8 marks, but exports are likely to rise as international currencies, such as the US dollar, can now buy more pounds. At the same time, imports are likely to fall. Again, why? Because the pound cannot buy as much in the global market. Combination of rising exports and falling imports helps to reduce the UK's current account deficit. It improves the current account. Now, that last bit, really quickly, just in case that wasn't really clear, because maybe maths isn't your best friend, no problemo. So the way to work it out in an exam is to just make up numbers on the side. So let's do it together. Let's say that I told you that exports from the UK are equal to, let's say, 600. And imports, what we import from the rest of the world, is, let's say, 1,000 to begin with, yeah? Okay, so I've chosen really easy numbers, and I made it so that we're purposely in a deficit, because in reality, the UK is in a deficit, right? What is x minus m in my completely made up example? Well, clearly it's minus 400, yeah? Okay, what we just worked out together is that when you become more price competitive, your exports will go up. So let's pick a number bigger than 600, let's be sensible, so like 700, yeah? And imports are going to go down, so let's pick a number below 1,000, say 900. Okay, look at what happened. X minus m now, can you see clearly, is equal to minus 200. What does that mean? Well, it means that the current account deficit shrank. It's not as negative as it was before. There was an improvement in the current account. Although that's all the 4 marks, yeah? Once you said that the current account is improving, the the deficit is shrinking, you've got all 4 marks comfortably, comfortably, comfortably. Right. So that's a nice starting point in terms of this booklet. Let's go into a few more questions to see how we get on. So, what does it say? The UK's net monthly balance of trade in goods and services by value, January 2014 to Jan 2018, is shown in the chart below. Right, firstly, before you even read the question or anything like that, notice that we are consistently and always in deficit. Yeah, we have never ever in this chart gone into surplus because it's always negative. Yeah, right. Which of the following can be inferred from the above chart? Okay, right. Let's zoom out a little bit. The UK government or the government was spending more than it received in taxation. Right, this is a very common error that people make. They mix up the fiscal deficit with the current account deficit. Right, let's just go through differences between the two very quickly as revision. Fiscal, also known as budget, is where the government are spending more than they receive in tax revenue in a year. So fiscal and budget are one thing. Hence why, by the way, you know, when they talk about the budget, the chancellor basically declaring what the different taxes are and government spending, that's fiscal. Yeah, that's one side. Then we've got current account and trade. Think about why they're the same thing. Current account is exports minus imports. Trade is exports minus imports. Yeah. So A is one of those that they put in there to try and trick you. It is not A. It can't be A because it's nothing to do with government spending and taxation. The UK's balance of trade by value was always in equilibrium. Well, clearly no, because I mean, at no point was it equilibrium. Equilibrium is zero, so no. The value of imports is greater than the value of exports. Well, yeah, because if we're in a deficit, it means that what we're importing is worth more than how much we're basically getting from our exports. So it's obviously C, yeah. The value of inflows is greater than the value of outflows. I don't even know what they mean by that. Just get in the bit. Yeah, is obviously C. Yeah, right. What do we have? Explain one likely reason for the UK's balance of trade in goods and services over the period shown. Refer to the chart on page 6. Again, by the way, they've clearly told you that you need to reference, but you should have known because it's a 3 marker. Right, so we straight away basically go that the UK's trade deficit increased from approximately, I don't know, what is that? 0.3 billion. Actually, no, let's start over here. So yeah, 0. Let's say 3 billion in 2016 to 5 billion in the third quarter of 2016, something like that. Yeah, I mean, that's the worst data reference ever. You guys can do better data reference than that, but just reference the data. That's one. Yeah. Right. So let's think about it. If the deficit is getting worse, what must be happening or what is likely to be happening? Is the UK more price competitive or less price competitive if it's getting worse? Are they more quality competitive or less quality competitive? Of course, less in both instances. So you've got a variety of answers. I only need to do one. Either the pound has appreciated. And just briefly explain that if the pound appreciates, makes British goods less attractive in the global market, less price competitive. So exports would fall and imports would rise. Remember, it's 3 marks. I don't need too much depth. Yeah. I could have said that inflation in the UK may have been relatively high because then British goods become less attractive. Exports would go down. Yeah. It could have been quality going down. Productivity of the UK workforce may have decreased. So the quality of what they produce may have decreased. Anyway, right. I think the easiest one there is just appreciate the currency. The currency may have appreciated, and that can explain why the current account got worse. Okay. Right. That is the next question. Right, let's go through this one. Again, very handily, they put dots for you, so I assume we're going to be referencing those two dates. Oh, come on. Calculate the percentage change. Are you joking, right? Guys, if you don't know how to do percentage changes, make sure you always plug it in the following order. New minus old divided by old times 100, yeah? You guys can do that by yourself, yeah? Just do new minus old divided by old times 100. You don't need me to do that with you guys. That's 2 marks. Explain the term current account, the balance of payments. Ah, cool. Right, I said this earlier in the video. So just the value of exports minus the value of imports, 2 marks. Simple. Yeah, you had to add the word value though. Right, good. Using the chart on page 6, which of the following may be inferred about the US balance of payments? Okay, this is very annoying because you're going to have to keep going back and forth between them. But let's quickly read them and see if we can kind of remember them. So between 2001 and 2006, the current account deficit decreased. Okay, let's see. The current account surplus increased between 2001 and 2006. There was a current account deficit for the entire period shown. There was a current account surplus for the entire period shown. Okay, let's see. So, I mean, we're in negative the whole time because look, this is 0. I mean, the answer is clearly C then. Sorry, that's quite boring. And I'd go through why. It's clearly not a surplus, so it's not D. Yeah. And we're in a deficit throughout the whole period. Yeah. This is just the value of their current account at different points in time. Even when it gets better, for example, from 2006, 2008, it's still negative. They're still in deficit. Yeah. So it's C, but let's just go through what the other options were. The deficit decreased between 2001 and 2006. Well, clearly no, it increased. And now a lot of people, by the way, mistakenly would look at this chart and go, look, oh, it's going down. No, but it's the deficit. It's a negative number. It's getting more negative. Therefore, it's increasing. Yeah, that's really important to understand. Yeah. So, anyways, right, we've really answered these questions. So let's deal with the other ones really quickly, and then I'm going to move on to a data response question that I want you guys to be able to answer. But hopefully, this is now making this topic a lot less kind of scary and a lot more straightforward. Right, this one is one of those where there is a lot going on. Yeah. So we've got the balance of trade in goods. So this is the UK. Can you see that the balance of trade in goods is consistently in deficit? We consistently have a deficit, meaning that the value of what we import in terms of goods exceeds the value of exports. Our balance of trade in services is consistently in surplus. So the value of what we're exporting to the world in services is greater than the value of what we're importing. And then very handily, the dotted line over here is the balance. Yeah. So can you see that we are always in a deficit, with the exception of actually that point there where it's pretty much balanced. Yeah, we're at zero in 2000. What is that? June 2013. Okay, right. Let's look at the options. You know what, let's zoom out a little bit if we can so we can see the options. So, which of the following can be inferred from figure one of the period shown? The total UK trade deficit was the largest in 2013. Well, no. In June 2013, it's the smallest because it's nearly balanced. The largest deficit occurs here in January 2014. Well, actually, equally with this one as well. Yeah. So, no, it's not A. B, the trade in goods was always in surplus. Trading goods, oh, I mean, it's already wrong. Yeah. Trading goods is in deficit at every point in time in that period of time. So it's obviously not that. C, the total UK trade deficit was the smallest in January 2014. January 2014, where is that? January 2014. No, it's the largest. Yeah. So again, they're trying to trick you. It's the deficit is the biggest at January 2014. It's not that. It's obviously going to be D, but let's go through why. The trading goods deficit was the smallest in June 2020. Okay, correct. Yeah, because it's hardly in deficit. Like it might be a tiny bit in deficit, but it's nearly at zero. So it's just D. Yeah. Okay, right. Explain one likely reason for the reduction in the UK total trade deficit in January 2015. Okay, right. So in January 2015, what's in January 2015? Oh, it's there. So it got a bit better. Right. You need to reference the data. Yeah. So you go from December 2014 to January 2015, the deficit decreased from about 2 billion, 2 billion, yeah, 2 billion pounds to about 1 billion pounds. Yeah. Okay, that's one. Straight away, get the reference mark out of the way. Get it out of the way so you don't forget. Right, that's one mark because it's three marker. Notice this one doesn't say reference the data. You have to reference because it's three marks, 3 and 4 markers in section A's. You must do it. Right, so let's think of reasons why. He either became more price competitive, he became more quality competitive. Like, then how easy is this? Yeah, the pound therefore may have depreciated. There may have been disinflation. The quality of British goods may have risen. I think just do it in terms of exchange rate. It's just easier. Yeah. So the pound may have depreciated. This sort of made British goods more internationally competitive, and therefore exports may have risen and imports may have fallen. Done. Right, last one, I promise. Yeah. Okay, what's this saying? The chart below shows the annual percentage change in the value of US exports and imports. Throughout the period, the US has run a trade deficit. Okay, well, that's useful to know. Now, okay, this one's actually a bit challenging because look, it's got the annual percentage change, and you can see that relative to the year before, it's not the total amount of exports or the total amount of imports. It's the percentage change relative to the year before. So if I look at, for example, July 2011, can I just make sure this makes sense? Zoom a little bit. If I look at July 2011, that means that relative to July 2010, yeah, exports have gone up by about 15.5% on it, 16%. And imports have also gone up by around 13%. Yeah. So it's really important that you understand what this data is showing. Yeah. Whereas if I look at, let's say, this period over here, September 2012, exports go up and imports go down relative to the year before. Okay, let's go through the options together. Let's zoom out. Right. So in the year to December 2012, the US trade balance improved. Right. So if we look at December 2012, well, if the trade balance improved, we would need exports to be going up and imports to be going down. Is that happening? Well, exports, yes, relative to the year before, there's a increase in export earnings, and imports are going down. So it is A. But I'll go through what the other options are. So I should have mixed up the order to make it a bit more exciting, but it's A. Let's see what B says. In the year to September 2012, the US trade balance worsened. Well, in September 2012 was actually one I showed you earlier. Exports went up relative to the year before, and imports went down relative to, so it improved. It didn't worsen, so it's not B. In the year to November 2011, so let's find November 2011. There we go, right? Notice that they both go up by then. Imports go up even more. The US trade balance improved. No, definitely not. It definitely got worse because although exports have gone up, imports have gone up at an even faster rate. In the year to August 2012, what's that over there? It says the trade balance worsened again. No, because in 2012, exports went up and imports went down. So the current account, the trade balance would have got better. Yeah. Last question of the booklet, I believe, of the section A's, and I'll do one quick overview of section B with you guys. Explain the likely effect of an increase in US income tax rates on the US trade balance. Right, okay, right. That's slightly different to what we've done so far. That's really important to understand. One of the things you would have learned about in theme two is conflicts between objectives. So ignore this question for a second. One of the conflicts between objectives is that when there's economic growth, people, because they have more money, will buy more goods and services domestically. That has no impact on the current account, but they will also buy more imported goods. And that worsens the current account deficit. Hence why there was a conflict between growth and the current account, having current account being balanced. Yeah. So in other words, when people earn more money, we expect them to import more. Well, if the government now increase income tax in the US, do you agree that that means that people have less disposable income? If people have less disposable income, then they will be able to afford less imports. The value or the quantity of imports are likely to go down, and therefore the US trade balance is likely to improve because they'll be importing less. Now, remember, it's 4 marks. What did I need to do? I need to reference the data. This may, so you could basically say this may have occurred in September or in December 2012 as imports fall relative to the year before by 4%. Yeah, that would answer the question really thoroughly. Yeah. So just to clarify, higher taxes means people have less disposable income. Less disposable income means they will demand less goods and services both domestically and from abroad. If they therefore buy less goods from abroad, they import less. If the volume of imports or the value of imports decreases, ceteris paribus, if exports stay the same, basically, you don't say that by the way, but the current account will improve. And that's it. We did. I don't know why I keep doing it with my hands. Sorry. We did that. The whole booklet. That's all the section A's that you need to know. And hopefully that really clarifies what you kind of need to understand. Right. I just want to show you guys one question, which I think is a very useful question for you guys to attempt as part of your revision. And it is taken from the old spec unit 2. So quickly, let's go to it. It's from January 2011. So let's go look at it. Here we go. And then I'll wrap up the video. So here we are. Right, in January 2011, they used to, in the old spec, have a choice of 2 data responses, and also don't be mortified. The big question's at 30 mark, but it's like the equivalent of 15 marks to the new spec. It really isn't that hard. It's just loads of marks for no reason. Here we are. The question says this. Evaluate the likely effects on the UK's current account on the balance of payments of changes in consumption, investment, and the exchange rate of the pound as shown in figures 1 and 2. Okay. Now, they will not ask it in this way in the new spec because they're not expecting you to do 3 analyses and 3 evaluations. It will be 2 analyses, 2 evaluations for 15 markers, 12 markers, etc. But because we want to kind of be holistic, let's cover this and do 3 analysis and 3 evaluation paragraphs. Yeah, let's start with the impact on the exchange rate, or sorry, of the current account on changes to consumption. So if I look at figure 2, or figure 1, sorry, can you guys see that consumption goes down by 3%? Okay, what is the link between consumption and the current account? Well, very simply, if consumption is falling, that would normally indicate that incomes are falling or consumer confidence is low. Now, by the way, they've added in an extra thing that you can give you even more depth, which is, can you see that stocks, they are like so random within the context of these components. They're all components of AD, and then we've got randomly stocks, which have gone down by 1,906%. Very, very smart ones amongst you have realized that this is relevant because it would lead to a significant negative wealth effect. Consumer confidence, people's assets are worth a lot less. So consumer confidence, this is the financial graph, by the way, consumer confidence will be very low. And if consumer confidence is very low, that will affect how people basically spend. Now, if they spend less, yes, they will spend less domestically, but they will also realistically spend less from abroad. Therefore, imports are likely to go down, and they do. They go down by 13%. Hence, the UK current account may actually improve. That's the analysis. It's number one. The evaluation for that, by the way, is that, well, it doesn't just depend on imports, it depends on exports. And this is a financial crash. It doesn't just impact the UK economy. Other economies were also impacted. Therefore, most economies would have experienced basically people's incomes falling, like our main trading partners in the EU. As a result, they would have demanded less British exports. So exports were also likely to go down. They did go down. They went down by 11%. So the current account might not be that much better off. Make sense? So you're basically saying, well, it depends on the other components of the current account. The next thing they wanted us to talk about was investment. Investment has gone down by 14%. What is the link? Well, investment is firms investing into new capital machinery. Do you remember how I said to always think of it in terms of price competitive or quality competitive? If they're not investing into new technology and the machines they have in the economy are starting to die out, do you agree that the quality of British goods are going to go down? We become less quality competitive. As a result, demand for British goods is going to decrease. Exports therefore go down, and therefore the current account worsens. Yeah. evaluation to that. It could be time lag. You could basically say, well, investment, it takes a long time for like existing capital stock to start depreciating. And also depends, because if you knew what was happening around the time in 2008, yes, the financial crash has occurred, and yes, of course, confidence is really low. The Bank of England have now reduced the base rate to 0.5%. So firms may start to borrow more money and start to invest. The government also cut corporation tax, but in a nutshell, this might just be temporary. Investment might start to go up because firms might start to borrow more money. Okay. The last thing they wanted us to consider, and I'm whizzing through this very quickly, is the exchange rate. Again, if it's not clear, write it out. So it shows £1 in terms of euros and dollars. So that means in 2004, £1 was buying $1.43, sorry, euros, whereas in £1 in 2009 was able to buy 1.1 euros. Did the pound depreciate or appreciate relative to the euro? The answer is depreciate. It's worth less euros. In other words, it depreciated. Same thing for the US dollar, by the way. So it was worth $1.90 in 2004. It's now worth $1.62. So it's depreciated relative to both the euro and the US dollar between 2004 and 2009. Does that make us more or less price competitive? Hopefully now you've understood, more price competitive. Exports out of the UK therefore go up, imports go down, justify why. That's the analysis. The eval to this, really straightforward, is if I look at 2008, 2009 exclusively, can you see that relative to the euro, the pound does depreciate 1.15 compared to 1.1, whereas against the dollar, it actually appreciates. So maybe, although we're more price competitive against the EU or Eurozone, we would be less price competitive relative to America. So they might cancel each other out. It depends in terms of the impact it has on the current account, who we do more trade with. So there we go. And that hopefully is the topic, really kind of demystified and really easy to answer questions on in an exam.